I think, revolves around the stock market, that great barometer of public opinion. And a couple of things I would note. First of all, if history is any guide, if the first week of January the market is up, history tells us the month of January is a good month. And so far that's been accurate. If the month of January is good for the market, that usually portends that the year is good for the market. So far we're 2 for 2. And probably the most important one is coming up this Sunday, which is the Super Bowl indicator. And of course the Super Bowl indicator has had an 80% success rate. So we should be mindful that if the Giants beat the Patriots this Sunday, you can forget about everything that I say, you can forget about everything that you've heard today, and just assume that 2012 is going to be a great year. Now, with that in mind, I guess listening to some of the speakers earlier today, I think there was one common theme that sort of rang through from what I could detect, and that was that we should be prepared for a lot of volatility. So I'm here tonight to tell you that we're not going to have much volatility over the next year or two. In fact, we think that you're going to see 2012 and 2013 actually be characterized by diminishing volatility in commodity markets, in the economy, and in the financial markets. And I sort of want to run through the outlook as we see it, and why we think there's going to be less volatility, and what that implies for agriculture directly. Now let me start simply by saying every year, roughly in December, we sort of take a look at a roadmap for the year ahead, and we attach a moniker to the year ahead. So as just some background, in 2010, we proclaimed 2010 to be the year of the Fed. And the reason we called it the year of the Fed is because we thought that the Federal Reserve would be maintaining a very accommodative monetary policy, not only in 2010, but really out to the year 2015, 2016. And then, in fact, the Fed would pursue a zero interest rate policy pretty much for as far as the eye could see. In 2011, or I should say in December of 2010, we proclaimed 2011 to be the year of the government. And the reason we called it the year of the government is because we thought that the issue of debt and deficits would really highlight the debate in 2011. And unfortunately, that really came to the forefront in August of last year with the debt ceiling debate and negotiations, which really deteriorated into a bunch of nonsense. In December of 2011, we decided to characterize 2012 as a year of paralysis. And what I want to do is go through now why we think that's the case and where we might go as a result. For starters, I think the global deleveraging process that really began in 2008 is still with us. It's still with us in spades, and it still has a long way to go. That deleveraging process has been highlighted by spotty and lethargic growth in this country, the emergence of recession in Europe because the debt debacle finally caught up with Europe, and as a result of sloppy growth in the United States and recession in Europe, it's now been translating into slower growth in emerging markets and developing weakness in China. And so as a result, global growth, which last year, in 2011, ran at something on the order of 3.5%, this year is likely to run at about 2.5% at best. Now, there are two positives, I suppose, or relative positives associated with a slowdown in global growth in 2012. Number one, global monetary policy is clearly easy. The Fed has been easy, is easy, and will continue to be easy. Europe which started out in 2011 with the European Central Bank actually foolishly raising interest rates, has already cut them and has sort of gone down the same road that the Fed has gone down now in the last couple of months with actual quantitative easing in order to attempt to bail out the European monetary system and the European banks. Monetary policy in China, which had been tightening all during 2011, is now in the process of easing. And monetary policies in other areas in Asia and the like is also swinging from restraint to ease. The upshot of all of that is that there's no shortage of liquidity. There's going to be ample liquidity in the global economy. And generally, when there's ample liquidity, financial markets tend to do well, and commodity markets tend to do well. The second characteristic, I think, of this global growth slowdown is that the prospect of inflation can be pushed further and further out into the future. In fact, I think if we go back over the last couple of years, one of our mantras has always been, or has consistently been, that we thought the risk of deflation was outweighing the risk of inflation, and we still think that to be the case. We think there is still a predominant deflationary tendency in the global economy. That's one of the reasons why monetary authorities are going to remain very accommodative, because they know the risks that are associated with a deflationary spiral. All they have to do is look over across the Pacific to Japan and see what's been going on over there. Just as an aside, I want to make note of one thing. The Japanese are not stupid people. The Japanese are very intelligent, and they've been going through a deleveraging deflation cycle since the early 1990s. Believe me, if there was an easy way out of it, they would have found it. And that's just to suggest that whereas our deleveraging cycle only began in 2008, 2009, it's only been going on for 3 or 4 years, we got a long way to go. Well, let's look at 2012. If we think back just 3, 4, 5 months ago, there was a lot of hoopla about how the U.S. economy was starting to revive, things were picking up, and all that sort of thing. And as we found out just last week, what we got out of all of that was about 2.8% GDP growth in the fourth quarter of last year. Better than the earlier quarters of the year, but it really pales in comparison to the kind of growth that we should be getting if we were in a real economic recovery. And even that 2.8% growth rate was sort of fraught with sort of one-time events. A lot of it was due simply to inventory rebuilding, which hasn't occurred and is not going to be repeated. Some of it was simply due to some pent-up demand that had to be fulfilled by a drawing down of household savings for the simple reason that households have no income growth because employment has been tepid and there's been very little wage and salary growth in the economy. And the third factor, I think at work that sort of propped up the economy in recent months has been the non-winter winter that we're having. If you just think about it, a lot of construction was probably taking place. There's so much construction going on in the world, in the U.S. economy. But whatever construction could take place was not being delayed in November and December and January. A lot of that construction could actually take place in those months because of the mild weather we have. When the weather's mild like that in winter, people get out more, therefore they tend to spend more, and that tends to prop up aggregate demand. The only problem with that is that it's not a permanent or structural phenomenon, it's a temporary phenomenon. And basically what happens, especially the way the data is seasonally adjusted, that you're really greater proclivity for the economy to slip back into recession than there is for the economy to sort of re-accelerate to a trendline growth path. My own guess is that we're going to mumble and fumble along as we go through the year. It's really not 2012, though, that the problem lies. The real problem lies with the fiscal train wreck that's out there ahead in January of 2013. And I'll just tick off a couple of things, or I should say I'll tick off a list of things that are about to take place in January of 2013. First of all the tax increases that are scheduled to finance healthcare reform start to take place in January of 2013. So there are a bunch of excise taxes, there's a Medicare surcharge, capital gains rate goes up, dividend taxes go up, et cetera, et cetera. That's number one. Number two, as we know from the failure of the super committee last November to reach a long-term budget deal, there are automatic spending cuts which are supposed to take place in January of 2013. And under a sequestration order, half of the cuts affect the defense industry, which directly affects production of goods and therefore employment. And then, of course, there are all the Bush tax cuts, the Bush-era tax cuts, which are scheduled to expire in January of 2013. And in balance, when you total all those things up, just for 2013, it amounts to about $500 billion of what we call fiscal drag to hit the economy beginning in January of 2013. Over 10 years, if all of those cuts were instituted, it would amount to something on the order of $10 trillion in tax increases and spending cuts. Well, let me tell you, if we have $500 billion in spending cuts and tax increases in January of 2013, that amounts to about 3% of GDP. And that's a horrendous amount. The economy would not be able to withstand that, and you can be most assured that the economy will slip into a real recession in 2013, if in fact those increases start to take hold. And if the U.S. economy slips into a recession, with the unsteady state that Europe is in, and with the weakness that's developing in Asia, I think you can be pretty well certain that a global recession would unfold in 2013. That's one of the reasons I think that the Fed, in its meeting last week, stretched out the time period by which they expect to keep interest rates very low for very long. Now, of course, much of this, I think, is going to depend on the outcome of the election in November. And I think we can probably safely assume that the lame duck session of Congress that takes place in November and December is going to be pretty busy in dealing with these issues. And I think how they deal with these issues is largely going to be determined by the outcome of the election. But in the meanwhile, I think with all of this ahead of us, it's going to be very, very difficult for not only investors, but for businesses to make intelligent decisions about their planning horizon, whether it be 1 year, 3 years, or 5 years. And that's why I think we can characterize 2012 as sort of a year of paralysis. People are just basically going to be hamstrung, and the economy is going to meander along until we get some resolution of these issues. Now, in that context, I was sort of hopeful of this in 2011 as well, and I thought we had a real opportunity and corporate profits rose something on the order of 14% in 2011, your first thought would have been, boy, the stock market must have done really well under those circumstances. And in fact, the market was doing pretty well up until last summer. And then, of course, when the debt ceiling debacle took place, the market went down. And even as the economy picked up in the last 4 months, all the market could do was basically finish the year unchanged relative to 2010. It wasn't because of the growth in corporate profits. It was simply because the market, in its infinite wisdom, was unwilling to pay for those corporate profits. And the way we say it was unwilling to pay means that the earnings multiple on the S&P 500 simply shrank in 2011 versus 2010. Now, what's curious about that is that if you look back over history, one of the things that we found statistically is that there's a very, very high correlation between the earnings multiple on the S&P 500 and a forward look at government's role in the economy. And simply the relationship simply goes that if government's role in the economy is increasing over time, the multiple tends to shrink. If government's role is declining over time, the earnings multiple tends to increase. I think with all the talk of Simpson Bowles and legitimate long-term budget reform in 2011, I think the market was very sensitive to exactly which direction government's role in the economy was going to take. And when that failed, the multiple simply sagged, and I think that was responsible for the market's seeming intransigence despite the growth in corporate profits. As we look toward 2012, I think the market is once again sort of focusing on what the role of government in the economy is going to be. And I dare say, even with tepid growth, even with slowing growth in corporate profits, if the market could see its way toward a declining role for government in the economy in the future, the market would be willing to pay more for those earnings, and you would see rising stock prices. If, in fact, the government's role in the economy is going to continue to increase or stay the same, you're going to see the opposite. The multiple is going to continue to shrink, and we're going to have a lethargic market. I think that's very important for you as farmers and farmland owners. But I think it's really important for you to think about what's taken place over the last 10 years, and think about how money flows from asset to asset to asset. If we look at the stock market over the past 10 years, we essentially find that it's gone nowhere. Returns on equities basically have been essentially zero. If we look at bonds have enjoyed a big run over the last 10 years, but now interest rates on long-term treasuries are around 2%. And I think investors universally are sort of scratching their heads and saying, Christ, 2% on a long-term government bond, what's my risk and what's my reward? And I think they're sort of thinking, well, I have a lot more risk than I have reward in an investment in government bonds. Personally, I don't think so, and I'll get back to that, but that's beside the point. But I think generally speaking, that's what investors are looking at. And I think when you look at equity, when you look at private equity funds, when you look at hedge funds and the like, keep in mind that they are looking for the best returning asset. And money tends to flow toward those assets which they think have the highest rate of return. And I think that's one of the reasons why you've been seeing outside money sort of flow into agriculture and bidding up the price of farmland over the last several years. Farmland has begun to look like a very attractive alternative investment given the record of equities and given the record of fixed income. So what I want you to think about is, let's assume for the moment that the outlook starts to turn and that government's role in the economy is going to start to shrink as we go forward, such that the market in its infinite wisdom will see that and begin to reward the market with a higher earnings multiple. such that you can begin to see a trend-like rise in equity prices, I think at the margin, you'd start to see some money start to flow out of agriculture, out of farmland, and into other alternative assets, i.e. equities. We all know that every commodity, whether it be farmland, whether it be corn, whether it be a bond, whether it be a stock, we all know that every commodity is priced at the margin. We know that once the price of that last subdivision in California in 2007 found no buyers, the housing market started to topple. And we can cite endless examples of that. And so my point is that farmland prices over the past several years have been bid up very sharply, to the point where even at current high commodity prices, it's pretty hard to pencil it out to make you think it's going to work on a cash-out basis. It's different long-term investment, certainly different. You own the land. I understand the idea that you're sick and tired of these other investments. Stocks have been volatile. Bonds don't pay anything. I might as well invest in something that I know and love, etc., etc. But I want you to think of the outside investor and think about how once money starts to flow from one area to another area, at the margin, demand starts to wane, and when demand starts to wane, prices then start to gravitate to more realistic type values. So all I can say is under a certain set of circumstances in here, one should be careful about this continuous bidding up of farmland values unless they can really pencil out on the basis of commodity prices. My own view is that commodity prices are probably higher than they should be. I think commodity prices have benefited significantly over the past couple of years by bad weather. Not only bad weather in the United States last summer, bad weather in South America this winter, etc., etc. But I think we should think about the supply side of the equation and think about the kind of output we can generate if in fact we get good weather. We know the cattle herd is shrunk. We know domestic demand is softening as a result of that. We know feed usage is down. We know the Chinese economic growth rate is slowing. Some people think it's going to crash. I don't think so. I think they can manage the economy to a slower growth rate. But at the margin, while demand for agricultural commodities in China might continue to grow, it's not going to grow as rapidly as it has. I think if we look at Europe and knowing what's going on over there and knowing that Europe is in a recession, I think you have to be careful about the demand side. And so my view of the commodity market is that it's going to be much more supply determined over the next year or two than demand determined. And if we get good weather, I think we'll see a huge increase in crop sizes, and I think we'll start to see prices begin to trend down. For quite a while now, we've been thinking that using corn as a benchmark, we've been thinking that corn could trade down to $5 a bushel, maybe somewhat under that, and that would represent a more reasonable equilibrium, knowing full well that prices always go beyond reason in both directions. But I think one must consider that possibility and think about the current price of farmland in relation to that, and think about how money flows could affect prices at the margin in your decision-making process. So my own bias is that the real key here, not only for agriculture, or I should say not only for the general economy, but also for agriculture and other sectors of the economy, is sort of what the role of government is going to be in the equation as we go forward. And if you can sense that there's going to be a return to more discipline in the government sector than there has been, and government spending as a share of the economy is going to start to wind down, think about those alternative investments and think about how the money flow could be redirected toward assets that have been out of favor, i.e. something like equities, and away from assets that have been in favor. Some supporting all of this and supporting, I think, this flow will be a continuing easy money policy on the part of all central governments as we look out over the next few years. As I said at the outset, the global deleveraging process has a long way to go. It's going to really be difficult to get the economy revved up sufficiently, to tighten labor markets sufficiently so that we can generate inflation. And so money will continue to be easy. And in fact, if I had to guess, I would think that there's a greater propensity for money to become even easier than to become less easy as we look forward. And so in my own forecast, not only do I think short-term interest rates are going to remain at approximately zero out to at least 2015, but I think the long-term trend in fixed income investments is still to the downside in yields as opposed to the upside. And so whereas the 10-year Treasury note, as an example, and I use the 10-year Treasury simply because mortgage rates are predicated on that, and most of the borrowing costs are. So whereas the current yield on the 10-year Treasury is around 2%, roughly 180, I would say there's a higher probability that we'll see the yield on the 10-year Treasury note go to 1.10%, and then we will see it rise to something on the order of 2.5% to 3%. And so I think you should factor that into your thinking as we go forward. It's interesting to hear people talk about debt and deficits and all of that stuff. And debt and deficits do in fact matter. But I think we can use Japan again as sort of an example. Right now, Japan, approximately 56% of Japan's deficit budget, 56% of Japan's annual budget is going to debt service. And debt as a percentage of GDP in Japan is roughly now at about 150%. And the yield on Japan's 10-year Treasury bond, or 10-year government bond, the last time I looked was 0.99%. So debt deficits certainly do matter, but under certain circumstances, interest rates can continue to go down. And as long as you have a central bank and a reserve currency, a central bank that is willing to monetize the debt, and a reserve currency that enables the government to print money, the debt will be financed at lower interest rates. And the thing to consider in there is that if you think of quality assets around the world, and I put quality in quotes, the number of quality assets around the world is continuing to shrink. There's the Bund, the German Bund, there's the U.S. Treasury note, and a few others. And so for financial institutions that have to buy high-quality instruments, that money or that liquidity is continually being funneled into a narrower spectrum of assets, and it's forcing prices up and forcing yields down. So think about what the equity market could potentially do if interest rates are staying low and going lower, and the earnings multiple is actually rising because of the change in the trend in government. Equity markets could explode. And markets have a habit of acting before it becomes obvious. And that's why I say at the margin, be careful of how the money starts to flow as we look ahead in here. So what are the chances of a change in direction of government as we look forward? About 3 years ago, we did a special study for a client, and we titled the study "The End of Six-Digit Budget Deficits and the Beginning of an Era of Seven-Digit Budget Deficits," thinking that we would be embarked on a long era where the deficit would exceed $1 trillion a year. Well, 2012 is going to be the fourth consecutive year now in which the budget deficit is exceeding $1 trillion. And yet interest rates have gone down in that period. If in fact we have a second term in the Obama administration. I'll make a bold prediction. I'll say that not burdened by the possibility of re-election or the need for re-election, we might actually see the Obama administration start to think about its legacy as opposed to getting re-elected. And I would argue, in fact, and this is really an outside-the-box argument, but I think there's a greater possibility for long-term budget reform under a second Obama administration that I would think would take place under the alternative. And I would not be at all surprised, not to see it so much in 2012, but to see it in beginning in 2013, that they begin to make a serious effort toward addressing the entitlements issue and start to address the spending issue. Agriculture is not going to be spared from long-term deficit reduction, no matter what shape or form it takes. And I think you should be prepared for a cutback in the safety net for agriculture as we go forward, even under a second Obama administration. If, in fact, that forecast turns out to be accurate, then that other forecast about the rising multiple would start to take hold. Under an alternative administration, I'm not quite sure what to say about the prospect for government in the economy. My guess would be that under a Republican administration, we would see a lot of those potential tax increases that are on the docket for January of 2013 simply be extended into the future. And to the extent that they are, without any corresponding increase in growth or cutback in entitlements, the result would be continued expanded deficits and continued tepid growth. And under that circumstance, one might even argue that under a Republican administration, the prospect for a change in the government, in the direction of government, might actually even be less than under a Democratic administration. So these are just some of the things that I think are going on out there. And in this environment, I think I mentioned at the outset that I thought as we go through 2012 and into 2013 that we would see a period of diminished volatility. I think one of the reasons where we're likely to see diminished volatility as we look out is precisely because there's so much uncertainty out there with respect to economic policy. I think a lot of investors are sitting out there, a lot of investors in all sorts of assets are sitting out there and saying, boy, there's a set of circumstances out there which could be extremely bullish, and I don't want to be caught flat-footed. And I think the same investors are saying, boy, there's a set of circumstances out there that could be extremely bearish, and I don't want to be caught flat-footed. And I think what that's resulting in is this kind of period of paralysis that I'm talking about. And I think in a sense everybody's sort of bunched in the middle, unwilling to make a move. And the result of that is going to be very low volatility as we go forward until one can see the directional move in whatever the direction may turn out to be. And then we'll see a huge move and the beginning of the trend. So I think that's something to consider not only for 2012, but also 2013. So finally, with those few words, let me just sketch out the kind of things I see in terms of commodities and financial markets. As I said, I think if we look at fixed income markets, your borrowing costs are going to remain very low. The Fed is going to remain very accommodative. Short-term interest rates are going to approximate zero. You're going to get nothing on your 3-month Treasury bills, 6-month Treasury bills, 1-year Treasury bills. You have to go further out the risk curve in order to get a decent return. That's going to be the case for 2012, and it's going to be the case beyond that. My own bias is that if you look at long-term fixed income assets, you more apt to see yields decline than to see yields be very cautious about hard assets in here, with the exception of precious metals. I think the trend in precious metals is likely to continue to be up, not because precious metals should be viewed as a hedge against inflation, but more likely because precious metals should be viewed as an alternative currency. There's sort of a race to the bottom in terms of currencies. Every country is in the process of wanting to depreciate its own currency in order to stimulate exports and hopefully have a positive impact on economic growth. And generally in those types of environments, I think you see precious metals continue to appreciate. In terms of the stability of the world, I heard earlier today that China was going to crash and that the euro was going to disintegrate and those types of things. I would put those as very, very low-ball probabilities. China has had a pretty good record of being able to manage its economy. The population is still moving from what I'll call the suburbs to the cities, and that's going to require continued fixed investment in China. And I think as we go forward, we'll see wages continue to rise and we'll see consumption take on a greater degree of importance in the Chinese economy than it has. Long term, that's good for food products and the like, but what does suggest is that a more stable Chinese economy, perhaps at a much lower growth rate, is more likely than the crash and burn type scenario. I think as we look at Europe, I think the European Central Bank has made it crystal clear that they're going to provide sufficient liquidity in order to try and get the banks, in order to help the banks recapitalize themselves and renegotiate debts. Countries are going to default. There's no question that Greece has already defaulted. When you take a 75% haircut on your debt, that's the equivalent of a default. And they're going to call it an orderly default rather than a disorderly default. But I think the price that's going to be paid for that is sort of more fiscal union in Europe. And eventually, I think we're probably going to see the emergence of what we'll call a euro bond, rather than each country issuing its own bonds. And as that sort of process evolves, I think you'll see the euro sort of start to stabilize, or at least become less of a risk than it has been. We might see some countries drop out of the eurozone in the next couple of years, and they would more likely be some of the peripheral countries like Greece and Portugal, which tend to have very little impact on the eurozone as a whole. I think given the prospect of slow growth, given the prospect of disinflation, I think on balance, the trend in commodity prices is sort of towards sideways to lower prices than it is toward higher prices. And I think on balance, individual commodities will sort of respond to their own supply-demand fundamentals rather than to responding to whether it be an inflationary trend or the like. And finally, I think looking at the U.S., I think, as I said earlier, the deleveraging process is ongoing. It's going to translate into something on the order of, at best, 2 to 3% growth for the next couple of years, at least, unless we can see some fundamental changes in the tax structure and in the regulatory structure. The one thing I think that's really positive for the U.S., and it's a trend that's now starting to develop and has ramifications for all industries, is that the U.S. has become much more competitive on a global basis in the last 2, 3, or 4 years. It's become much more competitive for 3 reasons. Number one, productivity has been strong in the United States. Number 2, wage growth has been very tepid. Auto workers in the United States, as opposed to the kind of outsourcing that has been so rampant over the past 10 or 15 years. It's going to be slow, it's going to be steady, it would be hastened if we had a more sane regulatory structure and a more sane tax structure. I think those are the only two impediments left now for a return of production back toward the United States. That would be good for labor markets eventually. It would be good for economic growth eventually, but it's a process that's got to unfold over time as opposed to something that's going to give us immediate gratification.
Hi, this is Sarah Schaefer with Top Producer Ag Web and Farm Journal, and I'm going to serve as your moderator today. And so we're still waiting on a few people to join in, so just hang tight and we'll get started very shortly. All right, well, we'll go ahead and get started. Vince, are you on the line?
Yes, I am.
Vince?
Yes.
Okay, great. Sorry about that. All right, well, today we were going to do our broadcast of Vince's presentation from the Top Producer Seminar. However, we had some audio problems earlier, and it just wasn't broadcasting well enough over the GoToWebinar. So instead, what we're going to do is Vince is going to do a brief summary of some of the economic topics he talked about at the seminar, and then we'll do a Q&A portion with attendees. So for all of our attendees, once Vince starts talking and we enter the Q&A portion, you can put your questions into the question chat area, and I will relay those over to Vince, and he'll answer them for you. In addition, if you want to ask your question to Vince, I can unmute you and let you ask it directly to Vince. So we have two options. So Vince is the President and Chief Executive Officer with LaSalle Economics. And so Vince, if you want to introduce yourself further and provide some opening comments, we'll go ahead and kick it off.
Okay. Well, the introduction has been done. I've spoken many times to many different farm groups, and we always touch on the macro economy, the outlook for interest rates, and the outlook for agriculture. And this one will be no different. I'll probably make some remarks that I didn't make in my earlier speech, just to take into account more current economic information as it's flowed out in the past several months. I guess one of the things that we had suggested was that the S&P 500, which we use as the barometer for public opinion throughout the world, would go over 1,400 by summer. And since we've already done that, we'll declare victory, although given the kind of weather that we've had over the past 3 months, it's pretty hard to distinguish winter from summer from spring, at least this year. But at any rate, we termed 2012, we thought, would be sort of a year of paralysis for the global economy as it sort of absorbed all the shocks that took place over the past couple of years, whether it be the Arab Spring or the tsunami and earthquake in Japan, or the European financial problems and the like. And while those were centered outside the United States, we highlighted a number of different upcoming events that would plague the United States in particular. And we sort of made a list of all the different things that could act as constraints on business decision making, whether it be the healthcare reform law, which is going to be debated by the Supreme Court next month, with a decision to be made this summer, or all the fiscal tax-related constraints, which I think we were probably the first ones to discuss late last year and early this year, but now it's sort of gaining flavor, and a lot of people are starting to write about it. And so I think attention is being focused on the fact that at the end of 2012, at least under current law, the U.S. economy is just going to be hit with a massive dose of tax increases, whether it be the expiration of the Bush-era tax cuts across the board, new taxes imposed as a result of the necessity of financing the new health care law, the Congressional Super Committee that was in charge of deficit reduction couldn't reach an agreement last November, so they punted, and automatic spending cuts go into effect in January of 2013. And now we also have, while we have a payroll tax extension to carry through 2012, that too is supposed to expire at the end of 2013. And basically, when you add all these things up, what it amounts to is over $500 billion of tax increases and spending cuts at the federal level that are supposed to take place in January of 2013. And that's about 3% of overall output as we measure by GDP. And the result of that is that if that is allowed to occur, the result of that is that the United States is going to be hit with another recession in the first part of next year, and it could be serious enough as to send the global economy back into a recession. Now, nobody knows whether all those tax increases are actually going to go into effect, whether some of them are going to go into effect, or whether none of them are going to go into effect. But the budget situation is in such dire straits that if they don't go into effect, the debt is going to balloon. And if they do go into effect, the debt may be reduced initially, but because it will send the economy into a tailspin, the debt would explode anyway. So I think the point of all of this is, number one, there's no easy way out of the kind of fiscal situation that we find ourselves in, at least in the short run. Number two, we really don't know what the law is going to be come January of 2013, and I dare say probably it's going to be largely determined by the outcome of the election. And number three, that as a result of that, we sort of felt that business in general and consumers and individuals in general would have a hard time making decisions and would pretty much be paralyzed as we go through 2012. Now, when I say paralysis, that doesn't mean that the economy itself is going to be paralyzed. Rather, we kind of thought that it would sort of mumble and stumble along in the kind of real, low growth mode that has characterized this overall economic recovery anyway. And I think on balance, as we look over the last 3 or 4 months, that's largely been true, although we have had sort of a burst of enthusiasm here because certain segments of the market, certain segments of the economy have looked better than expected. For example, housing, and there has been some better performance by the labor market over the past couple of months. The only problem with that is that it's hard to discern how much of that is real and how much of that is artificial. And by artificial, I mean that it certainly appears that a certain amount of economic activity has been borrowed from the future. If you think back to last year at this time, about 98% of the country was covered with snow, and it was a cold winter, whereas this year, not only hasn't there been any snow, but it's been mild. And so a lot of economic activity activity, which would normally not occur in the first part of the year, has been able to occur this year. And the question now is whether that activity is going to provide some momentum to the economy, or whether it's simply borrowing from the spring and the summer. In which case, then the economy will start to look a little bit more dull as we go through the spring and summer. Questions will start to arise as to whether we're running out of gas. That will bring the Federal Reserve back into play, with the possibility of more easing by the monetary authority. And at the same time, with the stock market having run up as much as it has, it wouldn't be surprising to see some sort of correction develop in the stock market as we go through the spring and summer. So that in summary is sort of how we viewed the macro economy. As far as the agricultural economy is concerned, we've been pretty much concerned not only by the prospect of continued slow growth in the United States, but also a continuation of sluggish activity in the rest of the world, particularly in Europe, which has really gone through the ringer in the last year, and more recently in Asia, where economic growth has clearly slowed down. And now the big question is whether China will have sort of a hard landing or a soft landing, and whether that'll reverberate throughout the entire world. The good news to all of that is that monetary authorities are keeping their feet on the accelerator, and so interest rates are staying low, and the world is flush with liquidity. But the bad news of all of that is that some of these problems are so structural in nature that they may be unavoidable anyway. Given the slowdown in the rest of the world, our feeling had been that the dollar would look like about the best currency amongst the bad lot in 2012, so that the dollar exchange rate would be supported. And we thought that, coupled with some developing weakness in exports, might have a negative impact on agricultural commodity prices. Given what we've seen over the past 3 months, if anything, we feel even more strongly about that, for the simple reason that it sure looks like, given the kind of weather that we've been having, there's going to be an early plant this year. I think there's going to be fence row to fence row planting. And so the thing is that if we get normal weather this summer and adequate moisture, I think we're going to be tripping over the grain in the streets of Iowa and in the gymnasiums because there's going to be so much there. And I think all of that will put downward pressure on grain prices, agricultural prices. And our big concern, of course, has been that with our farmland prices having gone up so much in value over the past several years, that with developing weakness and trend-like weakness in agricultural commodity prices, we might see a significant correction in farmland values, particularly when we look at farmland values as an asset relative to other assets which have performed poorly. We might start to see a flow of funds away from agriculture and into other areas, whether it be equities or other things. And so we raised that as a concern. It's something that one should be watchful for, and we just have to see how it all develops. So in a nutshell, that's pretty much what we talked about, and I'd be happy to take any questions.
Great. All right. Well, attendees can plug in the questions into the comment question box and kick a few questions off. I guess as a first question is that the dollar has been weak in comparison to the other monetary across the globe, and I was wondering, what will it take to increase the strength of the dollar again?
Well, in the last year, the dollar has regained some momentum. You know, it's sort of been a race to the bottom with all these different currencies, and that almost every country wants a weak currency because they'd like to promote their own exports, and they feel that a weak currency will give them an edge in export markets. So I think that's one thing, and that's one of the reasons why gold has sort of been a standout asset in recent years. But what it would really take to give us a trend line recovery in the dollar would be evidence of economic stability in the United States, such that the Federal Reserve could start to back away from the liquidity injections that it's been doing over the past 2 or 3 years. And so I think if we got government-sponsored policies, if we got government pro-growth policies in the way of taxation and regulation, and we cleared up some of the uncertainty that's on the docket for early 2013, I think that would create more certainty, and that would start to put a real solid floor under the dollar exchange rate.
Great. All right. Well, another question we have is that the emerging economies have kind of been front and center over the last 5-10 years. A lot of rumors about how, China's growing at exponential rates, Brazil, India, other countries like that. With the stress we've seen on the global economy, can these emerging countries stay on a pathward up, or are they falling back like we've seen with Europe and the U.S.?
Yeah, I think the emerging economies are still relatively strong performers, probably not as strong as they have been. However, I think as we look out over the next 5 to 10 years, I think my personal view is there's reason to be less optimistic about the performance of the emerging economies relative to the United States. And I'll just cite a couple of things. If we look at what's happening in China, for example, it's clear that wages are on the rise throughout all these emerging economies, particularly in China. And if we look at what's happened to labor costs in developed economies, particularly the United States, there's been very little wage growth over the past 3 or 4 years. We're almost at the point now when we compare labor costs in China and other emerging economies with labor costs in the United States. The United States is looking a lot more competitive than it has. That's number one. Number two, I think one of the side effects of the Japanese earthquake last year and tsunami was that it caused a lot of supply chain difficulties. It broke the inventory string. And I think as a result of that, it's at the margin giving some companies the incentive to keep inventory back near their home markets, which means more production at home as opposed to around the globe. And number three, I think we have to think about the cost of energy now. When we see what's going on in the United States in terms of, I don't want to call it an energy revolution, but when we see the huge increase in domestic energy production that's taking place in the United States, and particularly the low price of natural gas, which is used as a power source for many productive facilities, when you put all of those things into an equation and wrap it up, you can certainly make a much stronger argument now that the United States is becoming increasingly competitive in the production process on a global basis. And so what I'm kind of thinking is that with these forces in place, if we can get the right kind of tax and regulatory policies to encourage business, I think we could see a significant flow of production back to the United States. And if that's the case, then the emerging market economies are not going to grow as rapidly as they have in the past. The U.S. economy is going to grow more rapidly than it has in the past. And on a relative basis, we're going to be looking a lot better.
Great. Another question we have is, especially in January during your presentation, you touched on volatility and what's ahead for agriculture. So now that we're almost into planting season, is volatility still going to be the word everyone uses to describe agriculture and farming the rest of the year?
Well, as we look back to 2011, we used volatility almost to describe everything. And actually, things have become quite a bit less volatile in 2012. And my feeling had been when we spoke back in January, February, that volatility would tend to die down a bit. And it clearly has been dying down, and I don't expect there to be nearly as much volatility as there was over the past couple of years, which I think is good. It's good from a planning standpoint and the like. And I think even with respect to agriculture, well, the weather can always give us jitters and that sort of thing. I think if I'm right and that we get normal weather and we have the kind of production increase that I think is possible, I think it'll be more of a trending type market than it would be a highly volatile market.
Great. All right. Well, we have a question that concerns some policy issues. With the huge deficit that our government has right now, where do you expect to see cuts in agriculture in trying to solve some of that deficit issue?
Well, I wouldn't pretend to be an expert on that. I think the only thing I would say with respect to that is that I think there's going to be shared sacrifice. I don't see any way out of this with some sectors being sheltered and other sectors not. I think agricultural programs are going to have to bear some of the burden of spending cuts and the like. I think a lot of this, of course, is going to depend on the outcome of the elections in November, not only with respect to the presidency, but with respect to the shape of the Congress. And I think what we need to do is not so much worry about whose axe is going to be gored, but just hope that there can be some sort of consensus formed so that responsible policies can be undertaken to get us out of this mess.
All right. Well, just a reminder for our attendees, plug any last questions you have in for Vince. So another one is that farmers have been very lucky in the last few years to see high profits, record profits. So what could be looming on the horizon that could kind of crash these good times that we've been seeing in agriculture?
Well, I think two things. Number one, I think if I'm right, and I don't think this would crash the good times in agriculture, but if we move into a period of surplus production, clearly prices are going to go lower, and clearly incomes are going to be hurt. At least cash flows are going to be hurt. And if you wanted a double whammy, then we would, you suppose we had a real spike in energy prices as a result of the hostilities taking place in the Middle East, or the potential hostilities taking place in the Middle East. I think that's one externality that we hadn't touched on, but something that's clearly there and something that we have to worry about. I think that's number one. Number two, I think the thing that you have to worry about is, trees don't grow to the sky. And when you look at how much appreciation you've seen in land values over the past 5 or 6 years, you have to look at farmland, even though a farmer doesn't tend to look at it this way, but you have to look at farmland as an asset within a basket of assets. And you have to look at the outperformance of one asset class versus the underperformance of other asset classes. And you might start to see at the margin a shift, particularly among the non-farm community, to get out of agriculture and into other depressed assets. And that's the kind of thing that could cause prices to start to weaken at the margin and then accumulate from there. So I would be careful about that, and I think that's something that, something that's really difficult to see until it happens. But at these levels, I would tend to be cautious.
Right. All right. Well, we have one final question. With the wonderful and mild weather that we've been seeing in much of the Midwest, and with the upcoming big USDA reports on March 30th, what is your short-term prediction for grain prices this season?
Lower.
Good answer. Do you want to expand on why?
Well, I think we're going, I think there's not going to be any problem. We had floods at this time for the last 2 or 3 years in various areas of the Midwest. This year, it looks like we have ideal ideal weather conditions for planting. So we have ideal weather conditions for planting, and that's going when you see how much is in the ground and how much is in what kind of shape, I think that's going to be the first negative sign for prices. And then it's a question of what kind of weather we get this summer. If we get good weather this summer and adequate moisture, we're going to grow like crazy. And I think we're going to go from scarcity to surplus, and that's going to drive prices lower. I'm still sticking to my notion that corn will go below $5 a bushel.
All right. Well, Vince, you've provided some great insight and some really valuable advice for the farmers that we've had attending with us. So thank you very much for providing all of that insight.
Okay, great. Thank you for having me.
All right. With that, that concludes this webinar. So thanks, everyone.
Thank you.